also get in Sandip Agarwal, fund manager and co-founder at Sowilo Investment Managers. Sandeep, welcome to the show and wishing you a happy new year in advance. My question to you is, taking this large deal that Coforge has done, what does this really mean? Because a very mixed view coming in from analysts as well when you talk about valuations. Some are of the opinion that they're really thinking in advance, to get onto the AI game. Would you be I know you can't recommend on stocks, but how would you advise investors in terms of what this deal means for the sector?
Hi, good afternoon. Thanks for having me on the show and wish you a happy new year in advance. So my opinion is this, that this size of acquisitions, whenever they have happened in history, it comes with lot of things to go right from execution and exit clauses of the management, incoming management, and many things have to go right, particularly when you are priced to perfection. So if you see the transaction going by the notes of the analyst, it is around close to 4 times sales, which is not cheap at all, because some of the large names in the R&D space, product engineering space in European region are trading at half that valuation. So when you're paying such a handsome price, obviously the company must have done very good due diligence and they must be confident. And given the track record of the management of Coforge, they are really, really good. So, we cannot cast any doubt on that part. But my view is that, now everything has to go right for this to sustain, because the always, price has to be, price is very important determinant of how much return you can make. And here in this case, the price have been upfronted in the sense that it is a 4 times earnings and almost 20 times EV EBITDA. So that is not very, very cheap. So everything has to go right for them to make money. Synergies has to flow in. I think, the way dividends and buybacks are getting into full tax paid brackets, the choices which are there are limited, and that's also one of the reason which is there to choose between acquisition or to distribute the excess cash. And I think incrementally we are seeing this happening in the sector.
And overall, when it comes to the IT space, are the valuations right now at the buy zone, or should one still wait and watch?
So if you see the PE ratio wise, then last 5 year historical PE, if you see, we are at the lowest point. So that immediately suggests that you should buy all the tech stocks. Many of them are at historical low valuation, particularly the large cap ones. But if you go by PEG ratio, then you will see that they are insanely expensive. So in my view, only PE ratio cannot be a key indicator. We have to go by PEG ratio also, because growth has meaningfully gone down one slab in last 4 5 years, and hence last, if you see 12 to 18 months, we have very, very cautious on the space, and we are consistently been reiterating that we love the ER&D space, but we will buy that space also when the price and valuations are correct. Right now we don't have any comfort on any of the stocks in the space, because the growth rates have come down meaningfully. The PEG ratios are very, very high. So once they correct meaningfully, the PEG ratios come down, probably yes, why not? But currently I don't see much returns in the sector.
When it comes to the cement space, not much has happened throughout the year. Street was expecting price hikes to come in, but then because of GST rate cut, they could not even take that. Now in December month, we are seeing signs of some pickup in demand. But do you think that the key trigger for the cement space would be still a price hike, or demand of pickup in demand would also be something that the street would start cheering, given the fact that the sector valuations are not that expensive, and yes, there could be more capex push coming in during the budget?
No, so cement has gone through wonderful consolidation in last, if you see, couple of years. And while you are right that there is no meaningful increase in the prices and the offtakes have been also low, but I think with such a huge consolidation happening in the space, I believe that at some point of time pricing power will also come back, and also the demand uptick will also happen. So we have started looking at the space more constructively than earlier. Earlier it was a avoid for us given the valuations. Now with the valuations coming off and a substantial amount of time correction happening, we are very, very constructive on the sector, and we will see whenever right opportunity comes in, we probably will add something to our portfolio.
From cement, Sandeep, anything on the infra and the capital goods space? This space has been, you could say, under road. Some valuation corrections have happened, but no major signs of fundamental growth has happened. But Sandeep, anything industrial or capital goods looking like?
So the challenge is that private capex has not picked up. If you see the data, despite all the efforts by government and everything. So my worry is that till that private capex picks up, you will not see meaningful upside in the capital goods space, and that is the reason this space has also been hammered quite a bit in last few months. And we don't see yet any signs of quick revival. Some of the spaces within that obviously are doing well. For example, the cable and wires particularly has done well. I think that at some point of time, the power theme will also start playing out. So we have wait and watch mode because for two reasons. One, the stocks were very expensive. They are building in a lot of growth. I think because of private capex being mellowed down, it has not happened. But yes, India is a long-term growth story. So obviously, these sectors, even if they don't do well for 6 to 12 months, they come back with a very, very strong comeback. And that is the time you have to position yourself if the valuations are comfortable. I think we are still a little away from the comfortable part of the valuation, so we have to time it little more finer.
Thank you so much, Sandeep, for that. I know we were going to have a conversation only on IT, but I'm sure the viewers and the investors are going with little bit of more insights when it comes to cement and the infrastructure space, which will be helpful as well. But thank you, and good to speak to you.